Hello everyone, and welcome back to the channel. Today I want to talk about the housing market. I want to talk about what's happening in it, which markets to avoid, and why the Fed isn't fixing this crash anytime soon. So let's get into it. So first off, what happened that I'm now saying that the housing market is going to start crashing? Well, we're seeing some big downturns in a couple big markets. And here's just a few. We have Boise, Idaho. We have Denver, Colorado. Salt Lake City, Utah. Tacoma, Washington. And last but not least, Tampa, Florida. Now, these markets aren't seeing crazy big drops, but I want to give you the numbers compared to last year. So last year, we were seeing 3 to 4 out of every 10 houses dropping the price on their house. Now, that's a little different than what we're seeing now. We're seeing about 50 to 70% of houses are dropping their price this month. What does that mean for the market, and what does that mean for us? We'll get into those other questions in just a moment, but right now I want to talk about why this is. And as we talked about last week on the channel, which you can check out right up here, it's because of interest rates. Now, let me go over a small example with you. Let's look at someone that has a mortgage of about $380,000 and they put 5% down on their house and their interest rate is going to be around 8%. Now, right now if you check out Mortgage News Daily, they're going to show that the interest rate is 7.12%. And again, as I talked about before, that's for well-qualified buyers. If you're not well qualified, which means your credit score isn't quite 760, maybe 740, and you don't have 20% down, let's go ahead and add another percent onto that. So let's just call it a flat 8%. So you have a $380,000 mortgage at 8% interest and you put 5% down. So what's that payment going to get you around? That's going to give you a payment of $2,700. That's principal and interest only. Now, let's look at another example here. We have someone that has the exact same qualifications, but they wanted to buy a house 9, maybe 10 months ago. Their interest rate is 3%. We'll go ahead and do that calculation. And what does that give us? Well, that gives us around a payment of $1,600. That's an $1,100 to $1,200 difference in payment just because the interest rate went from 3 to 8%. Because of this, people are starting to stay with their current houses. They don't want to get into a new house. That's because their old interest rate is around 3%, and that's really a deal in today's market. But in order to get people into new houses, sellers are starting to look at a couple options, and that's incentives. One of them might be paying for closing costs, but another option is making it seem like they're actually giving you a deal when they're not. And I'm saying this because I think you have to look at more than just the numbers. Well, at least that's what I think. People are putting their houses on the market at crazy high values, and they're finding out quickly now that they can't do that anymore because of these high interest rates. That's making them lower their prices, and that's actually making the market look like it's going into a recession, but I don't think it's happening quite yet, but I think this is the start of it. As more and more people see people start to drop their prices, they're going to say, hey, I can't put my house on the market quite as high, but I need to sell this quickly. Let me put it a little under that, and maybe we'll have to drop it a little bit more. And that cycle continues and continues because people are able to buy less and less of a house as these interest rates continue to climb. Now, here's the really scary part. Remember how I just said interest rates are part of the reason for all of this? Well, they're not going away anytime soon. Last week, we just had a great jobs report, and initially you might hear me say that and think, wow, that's fantastic. Like, the economy is going to keep doing really well. I don't see any downturns. The recession is probably going to be pushed off into even later of 2023. This is great. But let's revisit this and think about it from a different perspective. Let's think about it at the Fed perspective, the Federal Reserve. They're saying, man, we had another good jobs report. The market's already too hot. The economy is already flourishing too much. We're having high inflation. We're going to have to raise interest rates again. And we're going to have to continue to do it for longer and maybe increase them faster and stronger. Because of this, I really don't see it getting a whole lot better. I think housing prices are continuing to go down. People can afford less and less of a house. Look at the example I gave you before. A $2,600, $2,700, $2,800 payment compared to a $1,600 payment before. People really just can't afford what they once could, and that's all due to the simple thing of the interest rate. I don't see that going away. I don't see that getting better. I honestly see it getting worse, and that's why the housing market is starting to crash right now. So guys, make sure to leave a comment below what you think is going to happen in the housing market. I think it's going to go down, and I think it's going to be kind of harsh now, but let me know what you guys think. Make sure you like and subscribe because it really helps out the channel, and don't be afraid to leave a comment about what you want to hear more about. I want this channel to be for you guys, so make sure it is. Anyways, that's all I have, so I'll catch you in the next one.